Welcome to Thoughts on the Market. I'm Sarah Wolf from the U.S. Economics team. Along with my colleagues bringing you a variety of perspectives, today I'll give you an update on the U.S. consumer. It's Monday, February 12th at 10 a.m. in New York. Lately, there's been a lot of mixed data on the health of the U.S. consumer. We saw very strong holiday spending in November and December, very strong jobs reports in recent months, but we're forecasting somewhat softer data in January for retail sales, and we know that delinquencies have been rising for households. When we look towards the rest of 2024, we're still expecting a healthy U.S. consumer based on three key factors. The first is the labor market. Obviously, the labor market has been holding up very well, and we've actually been seeing a reacceleration in payrolls in the last few months. What this means is that real disposable income has been stronger, and it's going to remain solid in our forecast horizon. We do overall expect some cooling in disposable income, though, as the labor market softens. Overall, this is the most important thing, though, for consumer spending. If people have jobs, they spend money. The second is interest rates. This has actually been one of the key calls for why we did not expect the U.S. consumer to be in a recession 2.5 years ago when the Fed started raising interest rates. There's a substantial amount of fixed rate debt, and as a result, less sensitivity to debt service obligations. We estimate that 90% of household debt is locked in at a fixed rate. So over the last couple of years, as the Fed's been raising interest rates, we've seen just that, less sensitivity to higher interest rates. Right now, debt service costs are still below their 2019 levels. We're expecting to see a little upward pressure here over the course of this year as rates are higher for longer, as housing activity picks up a bit, but we expect there will be a cap on it. The last thing is what's happening on the wealth side. We've seen a 50% accumulation in real estate wealth since the start of the pandemic, and we're expecting to see very little deterioration in housing wealth this year. So people are still feeling pretty good, still have a lot of home equity in their homes. So overall, good for consumer spending, good for household sentiment. So to sum it up, this year, we're seeing a slowing in the U.S. consumer, but still relatively strong, and the fundamentals are still looking good. Thanks for listening. If you enjoy the show, please leave us a review on Apple Podcasts and share thoughts on the market with a friend or colleague today.
The preceding content is informational only and based on information available when created. It is not an offer or solicitation, nor is it tax or legal advice. It does not consider your financial circumstances and objectives and may not be suitable for you.